Kia ora, ngā mihi nui kia koutou, e nu rangatira mā, nau mai, haere mai, whakatau mai, I tēnei hui mariko. Ka bere koutāho, ko te karahi o te putea whai whakao. Nō reira, tēnā koutou, tēnā tātou katoa, whānau, hara mai te toki, haumie, huie, taiki e. A warm welcome to you all. I'm Barry Coates, CEO for Mindful Money, and welcome to tonight's seminar. Mindful Money is a charity that aims to make money a force for good, as well as providing radical transparency for KiwiSaver and investment fund portfolios. We undertake these seminars to educate the public and highlight how investment can make a difference on issues that matter. This is actually the 16th seminar in this series out of 20. So you can see our website, our seminars page on the website for recordings on climate change, social housing, impact investing, investing in Russia, nuclear weapons, animal welfare, and last week, green property. So tonight, we're setting ourselves a completely impossible challenge. We're going to try and make sense of the complex and parallel universes of standards, disclosures, and regulations on ethical, responsible, and impact investment. So this seminar evolved from a discussion I had with Annabelle Chartres from PwC about the growing concern over greenwashing and misleading claims. So tonight we're talking about pathways to achieve clear standards that will restore the trust and confidence of consumers, asset managers, and regulators. We've got a great panel tonight to make sense of all of this, and I'm going to introduce them one by one, and then we'll have a discussion. And at that stage, you can ask us any questions. Feel free to use the questions button, and you can even vote on each other's questions. And then as the discussion goes on, I'll weave those into the conversation, but you can put your questions in at any stage. So let's kick off. My great pleasure to warmly welcome Joe Kelly. Joe is the CEO of the newly formed Toitū Tahua, the Centre for Sustainable Finance. Toitū Tahua has taken on the mantle of implementing the roadmap for sustainable finance, which was initiated by the Aotearoa Circle. Joe has previously been senior management at Deloitte, and director of the B team. She's a board member of B-Lab for Australia and New Zealand, and a board member of the Impact Investing Network. So very warm welcome to you, Joe. Coming up on screen.
There I am. Hi, am I supposed to be on screen? Hi,
you
everyone.
are.
Kia ora koutou.
Great timing, Joe.
Hi, nice to be here. Thanks, Barry, for the invitation.
Joe, just fill in any gaps about yourself and the work of Toitū Tahua.
Yeah, sure. I mean, I think you covered the basics. So the roadmap was developed by the Sustainable Finance Forum, early initiative of the Aotearoa Circle. I think it's useful for people to know that the roadmap took over a year to develop, and it was developed by a technical working group of more than 30 people, but ultimately those 30 people consulted more than 200 people, individuals and market participants to develop the recommendations. And standards are a big part of the roadmap. So the roadmap has been quite influential in the development of the TCFD regulation. The forum was established prior to the TCFD coming into play, and it's also resulted in a number of other standard-setting collaborations like SAFI, which is the Sustainable Agriculture Finance Initiative. And we can talk more about SAFI later if it comes up, but essentially it's guidance that helps banks and investors and different users identify activities that are transition aligned in the ag sector. So I think, you know, standards form a big part of the work of the centre, and we're very focused on how we can utilise better standards for our purpose, which is a sustainable financial system.
Sure. And Joe, you've I've tapped you on the shoulder to kick us off on the discussion around why we need standards. What is it that we need standards for? What are we talking about here? Isn't it just a kind of a bureaucratic burden in order to have too many standards? Give us the refutation.
Yeah, I mean, look, Barry, I think that there is no question that there are so many regimes, so many reporting requirements across, the financial markets, across our business activities. So it's a really important question. Why would we go and set about developing more? And even the fact that we're all here tonight, because it's so confusing and there's so much in the market already, I think, it's a signal that people start to feel a little bit overwhelmed by everything that's out there. But I suppose the answer to why we need more standards in some respects is, where do we want to go? So I was talking to someone yesterday, and I'm going to steal her quote. She said to me, "You can't regulate for greatness." And it struck me as just a very simple but quite powerful statement. And that woman was Julia Jones from the NZX. Thanks, Julia. And I think, I agree with Julia's statement. I think that this is about standards, but it's also about norms, and it's about our mindset. So if we think of guidance like SAFI or standards as a North Star or a compass, then they're something that we set for ourselves to be better and do better, and they're not just a ruler or a compliance exercise or something that's being done to us, which is, I think, how a lot of people feel when, every time something new comes along. And I see this borne out quite a lot in the B Corp community. I think B Corps are a really great example of this, because they're businesses that sign up for a really, really rigorous assessment, and they meet a certain threshold. And they, generally speaking, they all report that they find tremendous value in the process. So my view, and that of the centre, is that there's real benefit in looking forward at the economy and the society that we want to have, literally in the next 10 years. And that we then start to demand much higher standards and performance than we're currently achieving today with respect to sustainability, because then we can have a framework for shifting capital into activities that will help us to realise where we want to go. And I guess for me, just on a personal note, I really want my kids to grow up in a place, in a country that expects quite a lot more from itself and the people who live here and the people who invest here than we're currently getting. So I think it is important to decode, the alphabet soup and demystify all of these different definitions. But I also think it's really important to think about standards in a way that makes us perform better. And I suppose my parting thought is, better can't be something that's subject quite so much to individual interpretation. I think we need to align on what better looks like for us, and then start to try to track toward it.
Cool. Thank you, Jo. That's we'll come back to each of those themes as we go on with the discussion. Let me introduce Simon. Simon O'Connor has been the CEO of the Responsible Investment Association of Australasia, commonly known as RIA, for, I was looking this up, Simon, almost a decade. And in that time, he's grown RIA's membership to 450 organisations, managing over 300 trillion Australian dollars. Simon is chair of the Global Sustainable Investment Alliance, a global network of sustainable investment organisations. And he was formerly the co-chair of the Australian Sustainable Finance Initiative. Prior to joining RIA, Simon was economic advisor at the Australian Conservation Foundation. So Simon, very warm welcome. Thanks a lot for joining us. And thanks particularly since I gather you've just walked out of the board meeting. So I hope that's okay. Simon, please feel free to kind of fill in some more details for the audience around yourself and RIA.
Great. Kia ora all. Thanks for having me, Barry. Yeah, I mean, Joe's just set that out beautifully, I think, in terms of why we're talking about this often quite mundane and arcane kind of subject matter area. But, from a RIA perspective, and why I'm in this role, I guess, is because we want a type of responsible investment that actually delivers outcomes for the environment, for society, and for the economy, not just responsible investment that is in name and not in practice or in outcome. And I think and that's really, for 22 years or so, RIA has been working on this endeavor of actually shifting finance such that it's a force for creating change. And that change, we believe, fundamentally is going to help to deliver better long-term investment outcomes for beneficiaries and for all of us as well. So standards are something that are really important. We're going through this fundamental sort of professionalization of our sector right now, where everything we've done in ethical investing and ESG and impact investing and all the acronyms out there are slowly being hardwired into our financial services infrastructure and system. And this is not just a New Zealand or an Australian or this is a global phenomenon that's going on right now. And so there is just a huge amount of work being done to make sure it's hardwired in right. And I love that quote that you can't regulate for greatness. But we want to make sure that when things are hardwired in, they're going to deliver the kind of responsible investment, the kind of sustainable finance that actually does deliver in a manner that our clients, that us all expect of it. That's very much at the heart of how we work and the objective of our organisation.
Yeah, and I just want to comment on what you opened with, which is what do we need responsible investment for? And you related it to positive impact on people and the environment and climate change and the things that we hold dear. And I guess for standards, that is one of the issues, because for a lot of participants in the investment sector, responsible investment isn't necessarily about impacts, is it? It's much more around managing financial risk to the company or to the fund that an investment manager runs. So that issue of are we talking about standards for impact, or are we talking about standards for financial risk management? Is that?
Yeah, so you're right. There's multiple reasons and drivers why people come to responsible investment, and why I guess some of the largest fund managers and asset owners globally are committed to this is not always fundamentally because their first and foremost objective is to deliver a sustainable world or invest ethically. It fundamentally is underpinned by an understanding that this helps to better mitigate against risk and drive better performance. In many cases, that's a requirement under jurisdictional law, etc. But fundamentally, I think none of that can be achieved actually unless we're fundamentally protecting the natural capital and the social capital that underpins that economy and that future prosperity of the companies we're investing in, or the assets we're investing in. And I think where this conversation gets interesting is really when you think about that from a perspective of a long-term investor who's invested in and is dependent on, an economy that can prosper and flourish for decades into the future. And when you think about someone entering the workforce today who's not likely to be retiring until 2070, that's a fundamentally different view of value, of markets, of economies, and it forces investors, even from a hard-nosed perspective, to be focused on much bigger and broader range of issues and system-wide issues, and it sort of unpacks a whole lot of things. And so I think I think it's really important that we're in this midst right now of this kind of professionalizing and creation of standards. And for many of us in this area right now, it's a hectic time. There's no two ways about it. But what I'm really encouraged about is that amongst all of that activity going on globally, domestically, it is all starting to actually form a single ever clearer picture of this sort of convergence of approaches that do mean that we get to the end of the day today, and we know today what good practice looks like. Like, we know what greenwashing is and isn't, and we know, and there are globally acknowledged definitions as to what high standards of practice are. Some of them may be formalizing legislation in policy, some may not yet. But I think there is a very clear convergence as to what is meaningfully, and doing any of this responsible investment to a high standard is becoming ever clearer. And I think that's a really important direction we're heading.
Cool. So we'll come back to what that convergence is and how it can consistently be implemented without the kind of greenwashing confusion that we've seen in the marketplace. Let me bring in AJ and to complete our panel of three. Andrew Jamieson, that's commonly known as AJ, is a strategy and ESG partner at PwC. So he leads the sustainability and climate team that assists organizations in solving complex ESG challenges. ESG. When we talk about ESG, we're talking about environment, social, and governance issues. AJ has a background in environmental economics and has worked over 20 years in strategy and consulting, both here and abroad, with extensive experience across financial services, investment management, digital technology, and experience design. So a very warm welcome to you, AJ. Thanks for joining us.
Thank you, Barry. Just to point out, I'm here in Annabelle's place this evening. So thank you very much for giving me the time.
Yeah, no, you're very welcome, and you're here in your own right. So, AJ, can you sort of lead us off on your perspective of these standards, and feel free to add any information about your work in PwC.
Sure. Look, just briefly, the sustainability and climate change team in PwC, we've got about 20 people across the country. The work that we do sort of ranges from climate science, decarbonising, TCFD, right through to sort of ESG strategies. So not just the kind of the maturity assessment of businesses, but how can they lean hard into ESG issues to make their businesses better, for the betterment of their employees, better customer engagement and brand differentiation. And Simon and Joe have led us away wonderfully. I think there's a sort of a really interesting part about this, that it's not new. So people have been making decisions about how to allocate capital for millennia based on their personal values, dating back to churches. I was involved in some ethical product design in the UK at the turn of the century, and I think what's happening is that in a very good way, it's becoming a much more mature conversation. In our discussion earlier today, Barry, I was sort of looking at parallels for it, and one that sort of struck me is actually food labeling. So very very easily we have this kind of basic free from type of labeling that says it's gluten free or sugar free or fat free. This sort of deficit exclusionary labeling, and that's responsible investing used to be a bit like that. It was like, if we don't do tobacco, and if we don't do maybe alcohol, if we don't do defense, then that's easy. But what's sort of happened is people are getting much more demanding about the transparency of information of ingredients, and the providers are being asked to give much more detail, not just of what is in a product, but actually the origination of ingredients as well. And one of the sort of final points from Simon was about that transparency, and this is what we're seeing. And one other sort of point on what Joe had said earlier is that there's a real difference between standards being used as a ruler and standards being used as a flag and a banner. And in this sort of instance, we're doing some work currently with the Sustainable Finance group to look at standards for impact investing. And the same question is actually, do you use this thing as a ruler for people to measure themselves against, or actually do you use this as a flag to bear to allow people to understand that you're definitely a destination that they should allocate their capital to as an investment vehicle?
Cool. And let's come back to exactly that issue, because I'd love to hear in a little bit more depth where we come out on that, because I think for years there's been, shall we say, some confusion about standards and ethical investment. Now where we're seeing the rise of impact investment as a more of a positive benefit for society from investment, and there's a danger that we're going to go through the same hoops. So let's talk more about that with the panel, and please, Simon and Joe, join us. So I would like you, Simon, if you don't mind, to give us your perspective on some of the things happening in the international landscape, because there is so much going on, and I'm sure you see through your work as chair of Global Sustainability Alliance, you see many of the kind of the different dynamics across different countries around these things. Do you want to give us a snapshot of where you see
definitely, and I think the parallels in different countries are really stark right now, and I think this is something that everyone's grappling with. And what's become really super evident is none of us can instigate standards on our own in our own countries, because we already are standards takers from global developments, and there's a bit of a race, I would say, internationally in terms of who's going to own and set those standards. And Europe's very quickly out of the blocks, and as a result, we in this part of the world are having to already, a lot of the investment managers are already needing to meet requirements and standards and definitions from a European market perspective. And it's why it's so important that we start becoming standards shapers in our own rights in this market as well. But I think, it comes down to some really key principles, and I think underpinning this, what's really important is that there's transparency, there's honesty, there's really delivering what consumers are expecting of us. Consumer law applies here like it does to any other segment. And so what we're trying to sort of build into this is standards, definitions, frameworks, all of which should enable us, done well, enable us to actually shift capital towards more sustainable assets and businesses. So they're not the ends in themselves, they're merely the means. And I think there's a risk here that we very busily keep ourselves incredibly busy for the next decade coming up with beautiful standards and frameworks. And this to me is a real risk for us, and it'll because it won't necessarily actually deliver the end goal. And so we need to just keep an eye on that end goal of what we're trying to achieve through this. But good standards around disclosures, good clarity around definitions, making sure we are being consistent in the language used, we're not exaggerating statements. There are sort of key principles that underpin all of this, and I think that will help us go a long way towards delivering what sort of consumers are looking for, what our clients are looking for. But yeah, it's an absolute alphabet soup right now, and they all kind of are connecting like little bits of Duplo. I think that's what I'm hopeful. There's a lot of focus on the interoperability and the harmonization and the convergence, and it's really pleasing to see some of these acronyms merging together from a GRI and a SASB and an IRC into an ISSB. And so I'm not going to define them all, but just to give you a sense, there is that many levels of acronyms coming together, but there are really quite fast currents of activity to bring them together. And I think that's what I'm encouraged by, because we risk getting lost in the midst of the sort of the noise, and ultimately, we need to sort of bring that together very quickly and land that in a manner that's meaningful for people who are trying to look for responsible investment products to invest in them.
So Joe, kind of connecting this back to your comment on why standards, it seems that one of the reasons is if we don't, then we miss out on participating in international capital flows. If we can't meet standards set in, for example, the UK, and our two-way flow of investment between New Zealand and the UK is possibly our strongest flow, then we potentially don't get to play. Is that something? And I know you've particularly been looking at what's happening in terms of taxonomies and definitions. Do you want to talk about your perspective on that?
Yeah, sure. So as Simon said, Europe's fast out of the block. So Europe has a plan, sort of Green New Deal with European deal, and they've set up their classifications around sustainable finance so they can understand which activities are likely to get them toward that plan, and they're sort of becoming the de facto sets of classifications that people are using around the world to build off of to create their own taxonomies or sets of classifications. And so I think for us, there's two parts to it. One is that we want that, as Simon said, we're standards takers, so we want to continue to have access to markets that are using these sets of definitions or classifications. But I also think it comes to integrity in our own place and in our own market. So how do we understand, what process have we taken to come to some sort of an informed view about what are the activities that are going to help us with our transition? So it does, it is about that sort of in and outward flow of capital and making sure that we have sufficient capital to mobilize into those activities. But it's also about understanding for ourselves what those activities are. And I think that's what's really interesting about, intentionally forming a process by which you think about these things and you come to sort of an aligned view. I mean, SAFI's not, a panacea. It's not the be all and end all of standards, but it's been developed through a process that reflects multiple different stakeholder perspectives. And so then therefore is more likely to be much more relevant to a different, diverse group of stakeholders. And if we don't do it, I think you'll have pockets of kind of self-developed, industry-led kind of maybe aligned to science, maybe not, varying degrees of credibility, but we kind of need frameworks to work from. So I think the game here is to make sure that the process of developing those frameworks is inclusive and reflective of the place where we are. So we use the language at the center of globally informed, locally relevant.
Yeah. And AJ, you're part of a global practice, of course, and this stuff is kind of, I'm sure, daily fodder for you. How does this look from a PwC perspective in terms of the way you see standards cohering or not? Simon expressed some optimism around the fact that we're seeing some convergence. Are you seeing that from PwC's perspective?
Yeah, that's right. Barry, we operate in a global hive mind at PwC. It's pretty nicely tied up, to be honest. I can sort of speak to particularly the Asia Pac ESG practice. We actually are quite tightly linked. So we keep an eye on regulation as it rolls off of whichever legislature we're sort of talking to, and I think that the concept of New Zealand being a standards taker is actually kind of compulsory. So if you look at something like the European Green Deal, we are very fast going to be hit with some relatively surprising sharpness about issues like modern slavery, where locally actually, the legislation is slowly crystallizing. We probably culturally don't believe we have an issue here, although, case law would suggest otherwise. And quite soon someone else is going to crack down with a ruler that if you can't give positive assurance of the ethics of your supply chain, you will no longer be able to participate in some export markets. So I think it's critical that we actually keep an eye on those things, because the signing of those types of laws happens very quickly, and we need to be across them before they arrive. We spend quite a bit of time making sure that we're across those, as we do with other types of jurisdictional rules like accountancy standards, for example. I think the interesting part about this is that if you, for example, modern slavery, in what world wouldn't you already have looked at that? So these standards are partly for someone from outside of your organization to have positive assurance that you are a good destination for their investments, that you're a good corporate citizen, behaving yourself across a number of vectors and operating sustainably. But truth be told is that if you're not operating against an international standard, then what are you doing? Like I think in some cases these things are, they're a norm that you should be already be there, and actually the standard just gives you a structure to be able to go. Actually, that lets us ask the right questions and collect the right data to make sure that we've got this framed up simply.
It's actually a really interesting example, isn't it? Because of the modern slavery standards are built around the core conventions of the ILO, and those core conventions have existed for a long time. And I know I worked on those issues in supply chains in the 1990s, and so it's not as if these are new standards. They're being brought into a new context, and they're finally starting to be regulated and requiring disclosure. Which so is that a kind of example, AJ, of standards not which have to be developed or kind of formulated, but actually it's just a case of saying, as you said, in what world wouldn't you implement these things?
Yeah. And I also think some of these issues are the transparency point that Simon raised earlier. If you have to show it, you have to know it, right? So actually, just the action of having to provide transparency to the outside world, irrespective of whether you're meeting a bar, actually just having to tell people where you are at means that you have to pay attention to your own organisation. So just having to be transparent is actually a pretty good starter for getting the bar raised across the board. Yeah.
But Simon, it's also a matter of kind of what kind of transparency for what purpose, and is there a case for saying that certainly in the investment world, standards need to relate pretty closely to the strategies for impact, for the strategies for change that are used in order to be called a responsible investor
Yeah, standards need to grapple with the complexity of what it is to do responsible investment well, and that's not a simple thing. That's a complex, process-driven thing, like a good management system internally, and it should articulate all the elements of that. And it's more than just a policy, and it's more than just who's in your portfolio. There's a whole lot in between that's going to drive whether you're doing this stuff well or not. There's a live example. We grapple with this daily, where we certify investment products as responsible investment. So they go through a verification process where we dig really deep to ensure processes can be evidenced and substantiated internally, and that there's consistent application of that, and people are voting their shares and engaging, and there's a portfolio element of that. And our program has to be aligned with global norms and shifting standards and definitions, and is constantly mapping to European codes, etc. But it's a huge, detailed, deep dive to do that. And I think importantly, there's a lot of room for improvement in the market in terms of the implementation of responsible investment commitments into a managed fund or a KiwiSaver product. I think we're really used to financial services law and compliance and regulation. We're less used to the expectation of sort of scrutiny and transparency on the embedding the processes and practices around responsible investment. So 80% of the products that come to get certified by us get sent back to go and make improvements and changes, because they can't convince us that they have substantiated all the process internally. And so, but ultimately consumers need to be able to lean their hat on something that gives them a sense of confidence that what's on the label is being delivered in the product. And, a consumer's not going to do that deep dive due diligence. And so that's where a standard comes into play. That's where, and whether that's legislated or industry codes or others is really critical for giving that confidence. And I would argue that it's really critical for the credibility of our sector much more broadly, because that we can actually deliver on the promise of what we're making to consumers around responsible investment, around sustainable investment, impact investing. So it's really critical that we can kind of align that with really comprehensive underpinning processes that align with that standard.
Is there a difference, though, between the standards that you might apply in a certification system and those recognised by government. So I'm reminded in New Zealand, the FMA has said that they're going to crack down on greenwash and misleading labelling. And you have to ask yourself, misleading with regard to what? What are the standards that the advertising may be misleading from? And if the government doesn't recognise a set of standards around ethical and responsible investment, then it's very hard for the regulator to play that role. So should there be closer coherence between industry participants such as RIA and others and what actually government adopts by way of these standards?
Yeah, look, I mean, there's a bit of a mishmash across New Zealand in terms of how standards are incorporated. We have KiwiSaver default provider requirements around having fossil fuel exclusions and responsible investment policies in place. And then you've got consumer law guidance, and then you've got FMA principled guidance. And I think between them, if you're an asset manager or fund manager out there with an investment product, you know pretty quickly whether you're on the right side of that line or not. Like you need to be able to, I think the FMA has provided really helpful guidance to an industry that has many, many different approaches to doing this, and all of which have merit if they're done credibly and well. And so I think that FMA guidance is actually quite a smart way for them to set down. You need to be able to substantiate, provide evidence. If you're going to commit something, show me how you're going to follow through with it. And I think this is kind of a pragmatic but appropriate way to deal with a highly complex and diverse array of delivering responsible investments, whether you're an impact investor or an ESG investor who's going to try to change directors of the board on Exxon by voting directors off, or whether you're an ethical investor who's a faith-based kind of aligned values-based investor. So I think the really prescriptive nature is really hard to land in this space, but I think that principles-based approach can set a pretty clear and pretty high bar where and I think we would hope to see regulators starting to come out with some threats or some actual enforcement as well. I think that's actually helpful. I'd probably say uniquely we're one of these industries at the moment where we are calling for regulators to engage. We're calling for that regulation. We're calling for that further articulation of standards in alignment with what we think is the right way to do this.
Yeah, and Joe, certainly, as you have said, Toitū Tahua is calling for standards and regulation to apply to these kind of issues. Where are you pinpointing some of the gaps?
Where's the centre pinpointing gaps? Specifically, we're focused on the matter of taxonomies, or what I've been talking about, which is how we classify what is a transition aligned or a sustainable activity. And as AJ said before, we're also looking at where that intersects. So as Simon said, there's a convergence here with the sort of the impact investment ethos and the practice of understanding whether or not you're having the impact that you've set out to have. And so they're really the two areas that we're focused. What does it look like to put in place some thinking, some guidance around how we understand whether we're driving the outcomes we're intending to, and then across key sectors, how do we understand what good looks like, what is sustainable, what is objectively an activity that's aligned with the transition. And so this is not going to be for everyone. It's going to be for investors that say we want to, be participant in the transition, and we're making claims about that, and we want to be able to identify investment opportunities that are aligned with the transition. That's where the taxonomies are really helpful, because they help us to understand what good looks like, understand where we need to go. And they're at the early stages anyway, they're for people who want to get on board and want to do that type of investment.
And I think additionally, thinking of those pieces of Duplo, they all plug together. Like, they help the FMA to know when someone's on the wrong side of greenwashing. They help consumers to objectively measure one product versus another by defining, how much of its portfolio is green or not green. So I think they all support each other and build this bigger Duplo construction that's going to create that sustainable finance world.
So AJ, where are you finding your clients kind of out on some of these issues, where both corporate and financial sector clients, what are they asking for support on?
Yeah, so I think on a outside of investment management, you're seeing this come through in transactions. So you're seeing people looking at, the comparison is something like ESG due diligence, either as a buyer wanting to have positive surety that you're buying an investment or buying a company that is a good actor and has their house in order, or as a vendor actually to tell that story to extract a better price multiple. And I was just mentally playing with some Venn diagrams while Joe was talking, because I think that the terrain here that's interesting is the part between, because impact investing has sort of quite a different flavor to it, and that actually it's sort of centered around the impact that you're wanting to drive, either social or environmental. There needs to be a financial return, mainly so it's not philanthropic, so it's a slightly different one, whereas this conversation is sort of the personal values and financial returns piece, and they're kind of like actually in one of Simon's he's got on his and some of their material a really nice spectrum of this, across the ethical investment landscape, because it's sometimes we get a little bit caught up in the definitions of it. From our clients, people want to do the right things. Really, it's not much more complex than that, but actually it's really hard to know what to do the right things, because the ESG landscape is broad and it's complex, so I think that's sort of where particularly the principles parts of standards. So actually, what are the principles by which we're making decisions, and then the standards part, which is actually how do we measure them, and what are the tolerances for it. But that principles piece, I think people are all looking for, because it's a confusing landscape. It's even in the E part of ESG, it's sometimes difficult to understand actually what are the right activities, to Joe's point about the taxonomy.
And if the taxonomy is about sort of standards for measuring things, the External Reporting Board, as well as looking at climate disclosure, has also got on its list to look at broader disclosure on social and environmental reporting. Is that going to kind of help your clients, do you think, AJ? Because if you're a fund manager, you need the information from the companies that you're investing in, and typically that reporting is not at all standard.
Yes, no, it will. I think I've got a bit of recency bias. I was talking this afternoon with a gentleman called Surya Devi, who's at Macquarie University, and he's got he's an academic who works in inequality and modern slavery. The point that he was making was actually that we don't want to be where CSR was, right? Corporate social responsibility, which was the early iteration of this, then just turned into people just making stuff up. This is how we're being a good corporate citizen. We'll donate to Greenpeace. It was a very, very low bar. And his sort of view is, look, at the moment, our risk is, if we're not able to crystallize with some degree of clarity, what are the things that people should be doing and what is considered to be good behavior, then we may go the same way, which is that if there's not an understanding of what common standards are, if there's not an understanding of the tolerances, then you are opening yourself to greenwashing, because it's pretty easy to do some gerrymandering.
So thanks to those who sent in some questions beforehand. If anyone's got a burning question, we're fairly close to wrapping up. Try and keep these seminars pretty short and sharp. certainly sharp. So thank you all. Why don't we just sort of go around and say, if you kind of fast forward, and you say, in a few years' time, what are we going to look back on and say were the most significant things that were happening at this time that have actually made a difference? So what is it that's really going to shift the dial in terms of building trust and confidence in ethical and responsible investing and in impact investing? What's going to make a difference? Joe, do you want to kick off?
Oh my goodness, Barry, no, I don't want to kick off. Jeepers, what's going to make the difference? Well,
I guess you're going to say taxonomy.
Yeah, I've shown my hand. I really have.
Yeah.
I think that if we don't get together and have a really thoughtful kind of process for setting up some guidelines around, what are the new industries we need to build? What are all the new sort of things that need to come to fruition in order for us to realize the transition? And I think we don't know what they are yet. We know a lot of stuff. We know what we need to do, but there's so much innovation, so many ideas that we don't know about yet. And I think if we haven't gotten together and said, how do we shift some serious money into these spaces where these transition activities can emerge from, that would just be a huge fail. And so for me, what I see these, sustainable finance classifications or standards as the integrity piece of that, the sort of the architecture that allows that to happen. Yeah, so I think for me, that would be the one if we look back and we said, oh, we missed that. Everybody else in the whole world did it and we just didn't. That would be a fail.
Yeah, and if we don't jump on it pretty quickly, we're behind. Exactly. Simon, to you, and also there's a question that's just come in around to what extent can the pursuit of profit actually ever really be sustainable and ethical, or are we talking about different worlds here between financial return and ethics? Are we
just two small questions to end the evening on? You want 30 seconds on that? I can answer them both in no time.
I'll give you a minute.
All right, thanks. Yeah, so there's probably two parts that, I think fundamentally we know that there is no economic prosperity on a planet where we're depleting the actual underpinning asset base of our economy, like depleting the environment, trashing the soil, trashing the water, trashing the air. If we tear apart the social fabric of our communities of democracy, then there's no prosperous economy, and we can't make money on that. There's no way to deliver returns on investments that ultimately are there being saved to pay for our retirement in most cases. So we need that. I also think we're in the midst of a massive economic overhaul of our entire system, and through that there is a huge amount of money to be made and investment that is required. And so I'm going to use that as my answer that'll carry us at least through the next 50 years, and then I'm going to have another question, then we can address that sort of degrowth kind of issue. But I think in the interim we've got a lot, and the smart money is going to follow that, and they're going to follow it because it will make money, and it will help our retirement. So and the first question, if there's sort of one thing that I think we'll look back and go, for me, most of these standards are about making it is effectively kind of unlocking consumers' ability to know what they're investing in and to make choice. And I fundamentally believe that if we expose precisely who's doing this well and who's not, who's investing in the good stuff and who's not, consumers are going to choose and move their money. And the financial services sector is a services industry, and we will respond to consumer demand. And I think, we've got lots of evidence to say that consumers want to make sure they're doing well and doing good. Jointly with you, Barry, in the next couple of weeks, we'll be releasing some more research on that, which is exciting again. But I think fundamentally, disclosures, taxonomy, standards are all about making it easier for us to see who's doing this well and who's not. And it's really about unlocking that demand and the direction of capital.
Yeah, pretty good point. Thank you, Simon. AJ, any final comments where you think a significant change is going to come from?
Yeah, look, I'm just going to build on the shoulders of giants, because I think Joe and Simon did a fantastic job there. Because I think if you go forward and you're looking back and go, what was achieved, if clarity is achieved so that investors understand how to allocate their capital, into areas that builds the economy and the society we want, then job done. Like that's the original question, right? Which is actually how do you allow people the assurance that they're allocating their resources to the right areas?
Cool. Yeah, and standards are certainly a part of that conversation. Thank you all very much. I know that trying to cover a very wide territory in a very short period of time is difficult. I'm glad we didn't dive too deeply into any one issue, because that could have been a seminar. But the idea was that we should have an overview of the broader standards and regulation and disclosures. And thank you very much for providing that. So it's great to have you on the seminar. Thank you. So that's thanks to AJ from PwC, Joe Kelly from Toitū Tahua, and Simon O'Connor from RIA. Thanks also to our sponsors for this series of seminars, AMP, Booster, Generate KiwiSaver, Harbour Asset Management, and PwC. Special thank you to our audience. This was perhaps a more technical seminar than we normally have. So thanks very much for sticking with it. I hope you learned something from it and enjoyed the discussion. For those out there who are deep experts on it, then we'd love to hear back from you with any suggestions or feedback. Please visit our website to register for next week's seminar. We have a panel talking about Te Ao Māori investing, and that's kind of so important for us as a nation, and for the investment community to be able to understand and start to have examples of Te Ao Māori investing in our investing landscape. So please come back for that. We look forward to your participation. All of these seminars, as shown, on our website. So feel free to go there and have a look at them. See you online Wednesdays at 7:30 p.m. Nā manaki tanga kia koutou, ka kite anō.